Welcome to the Deep Dive. Today, we're really getting into Hercules Capital's Q2 2025 earnings call.
Yeah, we're here to kind of translate the raw data, break down the key insights, the strategies behind what looks like a pretty impressive quarter for this BDC.
Absolutely. Think of us as your guides here to unpack these results and maybe find some surprising bits along the way.
And this wasn't just, run-of-the-mill. It was a genuinely robust performance. Beat analyst expectations, showed really strong operational execution.
The market definitely reacted, didn't it?
It did. And we're here to explain why this matters for you.
Okay, so let's dive right into those headline numbers everyone was talking about. Net investment income, NII per share. Over in 50 cents.
Right. And for anyone maybe less familiar with BDCs, NII is essentially their core profit from investments.
So $0.50, comfortably beating the $1.47 consensus. That's what, a solid 6% upside straight away?
Pretty much. And, the good news didn't stop there.
No.
Total investment income hit a record, $137.5 million.
Wow. That's a, 10% increase year over year? Also big consensus.
Yeah, surpassed the $129.5 million number analysts were looking for. And they also hit record commitments, $1.0 billion.
$1 billion in commitments.
Yeah.
And record gross fundings, too.
$709.1 million. What's really striking isn't just the sheer size, it's the consistent growth. It points to a really powerful engine running there.
Mm-hmm. And looking beyond the income statement, the balance sheet seems strong, too.
Definitely. Liquidity across the whole platform was over $1 billion.
Okay.
And assets under management, AUM, grew to over $5.3 billion. That's a big jump, 16.5% year over year.
So it's not just growth, it's like an expansion of their whole operational capacity, their market presence.
Precisely. And what's maybe particularly interesting for shareholders is the net asset value, the NAV per share.
Right, the underlying value.
It saw a healthy increase, climbed by $0.29 to $11.84 as of June 30th.
So the actual sort of book value per share is growing. That's a key long-term indicator, isn't it?
It absolutely is. So yeah, overall, just a really positive picture for the quarter. No wonder the stock reacted well.
Okay, so beyond those impressive top-line numbers, what were the sort of strategic moves? What levers did Hercules pull this quarter that really, stood out to you?
Well, a really significant factor was their capital management. Very proactive.
How so?
They closed a $350 million offering of 6% unsecured notes due 2030.
Okay, so locking in long-term funding.
Exactly. It's not just about getting the cash. It's about getting stable long-term capital. Gives them huge flexibility.
And they didn't stop there, did they? There was the credit facility.
Right. They upsized their facility with MUFG to $440 million. So again, more liquidity, better access to debt markets.
It's like a double hit on the capital front, really strengthening that financial base.
It is. And these moves mean they have ample liquidity now, $785.6 million just within the BDC itself.
Okay.
And over $1 billion across the whole platform. It's a substantial war chest.
So they're positioned to fund future growth without feeling stressed, even if the market tightens up.
That's the idea, like a well-prepared athlete. They've got the energy reserve for the long haul.
And what about leverage? That's always a key metric for BDCs.
Their gap leverage actually decreased a bit to 97.4% or 95% net of cash.
Okay.
And regulatory leverage, the one the SEC watches, was 81.1% or 78.7% net.
Both within their usual range.
Yeah, well within their conservative operating zone.
Yeah.
So for you as an investor, it signals they're growing, yes, but also managing things prudently. Lots of headroom before hitting any red flags.
Right. So brings us to the direct impact. For listeners, how did all this translate into shareholder returns, distributions?
Okay, so they declared a total cash distribution of 0 to 47 cents per share for Q2.
And that breaks down into
a base distribution of 0 to 40 cents, and then a supplemental distribution of 0 to 7.
And the supplemental piece is interesting, isn't it? They have a history there.
They really do. This makes it their 20th consecutive quarter providing a supplemental distribution.
20 quarters straight. That's quite a track record. Shows real commitment, not just performance.
Absolutely. And crucially, the NII, their earnings, covered that base distribution by 125%.
More than covered.
And it covered the full distribution, including the supplemental, by over 106%.
So strong coverage, sustainable payouts. That's fundamental for anyone looking at the dividend.
Exactly. They're earning more than enough to pay it.
Now, beyond the direct lending, there's this other piece, the advisor platform. What's going on there? How does that fit in?
Yeah, that's another interesting angle. Post Q2, their subsidiary, Hercules Advisor LLC, announced the first close on its fourth private equity fund.
Okay.
This platform now manages 4 funds, about $1.6 billion in committed capital, both equity and debt.
So it's not just managing more money, right? There's a synergy there.
Oh, definitely. Think of it as like an intelligence hub. It generates income, sure, but it's also a proprietary pipeline into the venture world.
Giving them first looks, building relationships.
Exactly. Relationships that fuel their main lending business. It gives them a real edge over more generic lenders.
And it contributes directly to the BDC's bottom line, too.
Absolutely. The advisor paid a Q2 dividend of $2.1 million to the BDC.
Okay.
Combine that with $3.4 million in expense reimbursement, and you get about $5.5 million in NII contribution just from the advisor platform.
So it diversifies income, deepens those venture connections, creates real value.
Yeah, strengthens their whole market position in a way that's frankly hard for peers to replicate.
All right, so with all this growth, all this activity, the big question is always credit quality. How's the portfolio holding up?
Actually, it improved, which is pretty impressive given the environment.
Improved, how so?
The weighted average internal credit rating decreased slightly, went from 2.31 in Q1 down to 2.26.
And for Hercules, lower is better, right? Means less risk.
Correct. Lower number, stronger credit quality, and it's still within their normal historical range, which is a good sign amidst all the expansion.
Okay. And what about non-accruals, the loans that aren't paying?
That number went down too. Only one debt investment left on non-accrual status.
Just one out of the whole portfolio.
Yeah, represents just 0.2% of the total portfolio at cost. So very few loans are actually in trouble.
That's pretty minimal.
And they also successfully resolved workout efforts on 3 loans that were previously rated 5, the lowest grade, including that legacy one, Koros.
Yes, Koros. I remember that one being mentioned before.
Well, they managed the workout really effectively. The realized loss ended up being $6.5 million less than what they'd previously impaired it for.
So they actually saved money compared to their estimate, and that helped NAV.
Exactly. It directly boosted the net asset value, a tangible win, and it really speaks volumes about their proactive management and their recovery skills when things do go sideways.
Okay, this disciplined approach, strong credit, it leads us to look forward. What's the outlook now for new originations, new funding?
Well, Q3 is typically their slowest quarter for new deals. That's just seasonality. But management said they remain constructively bullish on their pipeline. They actually expect to end 2025 with record commitments and fundings for the full fiscal year.
So confidence is still high for the year, despite a potentially slower Q3.
Seems so. But they did signal a more, let's say, selective approach specifically for Q3.
Okay, why the increased caution now? What's driving that?
They mentioned observing what they called aggressive lending practices from some other lenders out there.
Competition heating up.
Apparently. Especially in certain sectors. Some lenders seem willing to go below Hercules' yield targets or operate with less structure, maybe chasing asset growth.
Because there's a lot of liquidity sloshing around.
That's their take. They see it as driven by market liquidity and maybe a desire for growth, not necessarily a permanent shift in what makes a good deal.
So Hercules' strategy is?
Stay disciplined. Focus on the long term. Avoid deals that don't offer the right risk-adjusted return, even if it means maybe doing slightly less volume in the short term.
And this is where having all that liquidity and low leverage becomes an advantage, right? They can afford to be patient.
Precisely. They don't need to chase deals. They can wait for the quality ones. What they might give up in quantity, they believe they gain back in long-term portfolio health, which, ultimately supports those distributions for investors.
Makes sense. And they actually confirm they feel underlevered right now.
They did. Explicitly said they're underlevered relative to their comfort zone.
So they plan to take leverage up.
Gradually, yes. Up towards the 105% gap leverage range. That's before they'd even really consider using their at-the-market or ATM offering again.
Right, the ATM being that flexible way to issue shares.
Yeah, and they stressed it's mainly for balance sheet management, not for actively trying to pump up NAV. It's a very measured strategic approach.
It's like they know they have more capacity, but they'll only use it opportunistically for the right deals.
Exactly. They can be selective.
So how does this disciplined strategy fit into the broader market? What's the feeling in, say, venture capital and M&A right now?
Well, VC investment activity is still healthy. $69.9 billion invested in Q2.
Okay, that sounds pretty robust.
It is, although, a lot of that is still concentrated in those later stage mega rounds.
Right. So does that affect Hercules' niche? They focus more on growth stage venture debt, don't they? Are they getting squeezed by bigger funds?
That's a fair question. But their sweet spot is still that specific venture debt for growth companies.
Yeah.
It's often a different need than those huge equity rounds.
So they still have their space.
It seems so. Competition exists, of course, but their relationships, their track record, that whole advisor platform we talked about, it gives them a strong competitive advantage, a moat. They focus where their expertise really counts.
Okay. And M&A activity.
Yeah.
Still the main exit route.
Yeah, M&A exit value for U.S. venture-backed firms was $32.2 billion in Q2. So exits are happening, maybe a bit slower, but M&A is still the key path.
And what about IPOs? Is that market really opening up again?
Management sounded cautious. They said IPO activity showed improvement, sure, but the bar for a successful IPO remains really high.
So they're betting M&A stays the primary exit driver for their companies.
That seems to be their expectation. More pragmatic, perhaps, reinforces their focus on companies likely to achieve a strong strategic sale.
Gotcha. Any thoughts from them on changing tariffs, trade deals? How might that impact the portfolio?
They actually sounded pretty optimistic. They believe increased investment in the U.S., maybe driven by some of these trade dynamics, will ultimately be a net positive for the tech-focused growth companies they back.
Interesting. So they don't see a major negative impact from tariffs.
They anticipate no material negative impact. Seems their portfolio is either less exposed directly or perhaps well-positioned for any kind of, reshoring trends.
Okay. It's also worth just quickly touching on the broader market context for BDCs. The peer ETF, BIZD, was down a bit last quarter, right?
Yeah, BIZD was down about 2.5%, but Hercules' stock actually saw a positive reaction after these Q2 earnings.
So clear outperformance versus the peer group.
It really underscores their unique position, their scale, their access to debt markets, that disciplined underwriting, even when spreads are tightening and competition is, as they said, aggressive.
It allows them to out-originate peers, as they put it.
That's their claim. They really emphasize quality deals and careful leverage management as the keys to sustained success, rather than just chasing volume. It's about the long game.
All right, well, that brings us nicely to our This Is Not Financial Advice segment. Time to kick around some outrageous but plausible trade ideas. What have you got for Hercules?
Okay, so given everything we've discussed, the performance, the guidance, the strategy, here's one. The under-levered yield accelerator play.
Under-levered yield accelerator. Okay, sounds intriguing. Break it down.
So management told us they're under-levered, right? And they plan to gradually increase that leverage back towards their target range, maybe 105% gap.
Before they even need to think about issuing more shares via the ATM?
Exactly. So the thesis is this. Go long Hercules. You're betting that with their record pipeline, tons of liquidity, and that proven discipline, they will successfully deploy that extra balance sheet capacity
Into more high-quality loans.
into more high-quality income-generating loans. And because they have this strong commitment to the distributions, both base and supplemental, and they're well covered,
This deliberate increase in earning assets could lead to even better NII growth.
potentially outsized NII growth, yes. And therefore, an accelerated yield for investors without necessarily diluting existing shareholders much, if at all, in the near term.
So the outrageous but plausible part is betting on a company choosing to add leverage now when others are being aggressive.
Kind of. It's betting on their specific ability to do it smartly. You're betting on their selection process, their patience, their execution to find the right deals to lever up into, even in a tricky market. It's a confidence bet on their strategy compounding over the long term.
A bet on disciplined execution in a frothy environment. Okay, so that wraps up our deep dive into Hercules Capital's Q2 2025 earnings.
Yeah, definitely a quarter marked by records, smart balance sheet moves, consistent shareholder payouts, and a pretty confident, disciplined outlook.
They really seem to be using their scale and that conservative underwriting approach to navigate what sounds like a pretty dynamic competitive market.
For sure. They're distinguishing themselves with that strong credit quality and the advisor platform, which adds, real proprietary value. They're not just growing. Feels like they're trying to grow smart.
Well, thank you for joining us for this deep dive. As always, we encourage you to continue your own research and maybe mull over this final thought. In a market that often seems focused on short-term wins and chasing deals, can a company like Hercules, with its focus on discipline and strategic patience, truly carve out a sustainable edge for superior long-term returns?
Something to think about.
We'll be back soon with another earnings breakdown.